Joining us from London to talk about all of this is Jan Randolph, the Director of Sovereign Risk at IHS Global Insight. Jan, good to have you with us. And, there's all these comments coming out to try to reassure the markets. But essentially, Jan, and we're all scratching our heads, why didn't this aid package for Greece work?
I think because the authorities were so late delaying it, putting it together. They were behind events rather than in front of events, and so it didn't work as a positive confidence booster. And now we've got the risk of contagion. Last thing we want is a rerun of the Asia crisis where the weakest link, Thailand in the case of Asia, Greece in the case of Europe, dominoes onto others. And the way that works, obviously, in finance, everyone looks at what the knock-on impact is from one bank onto another, who's got exposures. But it's all about ring-fencing Greece, and that's what the European authorities need to do.
Well, how high is this contagion effect?
Well, we're seeing it in terms of risk spreads. It works. I think the key to understanding it works through the minds of analysts, market analysts and bank analysts. They will look at similarly placed countries, look who else might be vulnerable. And we've seen risk spreads go up for similarly placed countries like Greece, like Portugal, Spain and Ireland. Although I personally think there's a big credit risk distance between Greece and the others. But the markets seem to be overlooking that because the sentiment's so poor.
Right, exactly. They do seem to be overlooking that and comparing them, almost treating them as the same. But yeah, the ECB leaders are meeting. They're going to be meeting actually very shortly to talk about Greece. How do they ring fence then this crisis?
Well, it's important that the country doesn't implode from the inside. We've seen the demonstrations. The government's got to pass the austerity package at home. That's terribly important. But by and large, it's got to take the people with it. The demonstrators may not be representative of the entire Greek population. But we've also got to make sure that the commercial banks don't bail themselves out of this package. The money comes in from the IMF side, and it simply redeems the bonds of the commercial banks. And so they've been speaking to the global banks and they giving assurances that they'll maintain exposures in Greece. That's also important in terms of maintaining the ring fence.
Then what can we expect then in the coming months? Yeah, what might we expect coming out from the ECB leaders? If there's a moment to make some hard decisions, now would be the time.
Yeah, I think what we'll see over the next few months is some pretty big, momentous decisions made by the European governments and the ECB. It usually takes a crisis like this to force these kinds of decisions. And the sorts of things we will see probably is the ECB given enhanced powers. It's already relaxed rules in terms of the rating of collateral criteria it uses for lending.
Right.
That makes sure that European banks keep liquid. If the European banks keep liquid, that means the sovereigns are kept liquid because they're the big buyers of sovereign bonds. It's these sorts of things, beefing up the ECB powers in order to ensure stability in the system.
Really quickly, we're facing some debt problems here in the U.S. and also in the U.K. Why aren't we more vulnerable to these types of fears?
It's a very good question. Sovereign risk has become the tail risk after having rescued the global economy a year ago. So we've seen plunging fiscal deficits, rising debt levels, and then quite frankly, a lot of the debt metrics, financial debt metrics, aren't that different, really. The difference between the US and the UK and these peripheral Eurozone countries is that they don't have the policy options to regain competitiveness and growth. Growth is the great redeemer in terms of solvency. They can't unilaterally weaken their currency. They can't unilaterally keep interest rates low for long periods. That's on the hands of Frankfurt. So their hands are tied, and growth is the key here. If we can get growth back, these solvency issues will improve.
Okay, all right, so we've got more flexibility here. Jan Randolph, good to talk with you.